So today we are going to talk about a stock which belongs to a sector which has not done much in last 3-4 years, but this sector has been, one of the most predominant sector when it comes to wealth creation. So the company which we are going to look today is City Union Bank. What we will do is we will cover the following topics. So why we are interested to study this stock, and we have this chart here where we have almost all the prominent large and mid segment banks, and I have taken the data from 2009 to highlight from 2009 till now what is the kind of return the stocks in this sector has given. If you look, there are 3-4 things. The company which we are going to discuss, which is City Union Bank, the return of this company has been fourth in this sector, which is not bad given 10-12 stocks, not the best, but not the worst. And in fact, if you look till 2019, it used to be second best performing stock out of 10-12 banks. And right now, still it is fourth. The other thing to note is, this whole sector looks like peaked out somewhere between 2018-19, because after 2019-20 in terms of returns, the sector has not yet crossed those returns. So we are still somewhere around 2019-20 returns. So that is important to note. And City Union Bank, it's a mid-tier bank. If you look at the number 1 to 3 players, basically, these players are the bigger players like Kotak, HDFC, and Indus IND. So after Kotak, HDFC, and Indus IND, based on 13 year of history, City Union Bank has been the next best performer. So the history says that something good the company has done, and that is why for a long time it was almost the second biggest highest return bank, and now still it is the fourth highest return bank, which is not that bad. That means company might have something. The second reason to study is as a part of value investing process, because I would categorize this stock as a value stock, which may not perform soon, but these kind of sectors, when the stock when the value emerges and when the cycle changes, they create a decent amount of money. And if we look at the banking cycle, if you look at the history of banking cycle, whether you look at the corporate loan growth, or whether you look at the rural loan growth, or you look at the retail loan growth. So retail is something which has done well, but if you look at the corporate loan growth, or the the rural loan growth, looks like we are at the bottom of the cycle, because if you look at the private sector bank loan growth slowdown, we are somewhere close to where we were in 2009, when the overall credit growth rate hit a bottom, and from there again it reversed, and we are again at the same cycle of almost at 7-8% kind of growth rate, which is the bottom. And if we look at the corporate loan growth, it bottomed in 2017, went up, and again it is around the same loan growth, almost at a 0% level, which means basically the loan growth, whatever has happened, has come from the retail loan growth cycle, which is still down, like from 18%, this has come to 9%. The worst case scenario was again in 2009 period, around 5%. So I don't know if this is where the cyclic bottom will be met, but looks like we should be somewhere close to the credit cycle growth rate. And if Indian GDP has to grow at, we say 7, 8, 9%, that growth cannot happen with the banking credit growth cycle being at such, low single digit. So this is like one interesting data which excites me to look at, companies in this sector, though there are different kinds of risks, and we will talk about it. So given these two factors, let's get into company analysis. So when it comes to banking as a sector, it's a very, very different sector. The way it works, the way the P&L is, the way the balance sheet is, it's very different from any other sector. And I have tried to create a basic understanding of banking in this particular video. So in case you're very new to banking sector, I will suggest you go and have a look at this video. So little bit about the industry before we look at the company. So if we look at the banking sector, both on the liability side and on the advances side. So basically your advances are the loans which are given, and liabilities are the deposit. And if you break this sector further, you have private sector banks, you have public sector banks, and bank in focus is basically we are talking about CUB, and HDFC is something which we treat HDFC as gold standard. The idea is not to, again get into whether CUB can be next HDFC. I think those debates are not there. CUB is a very, different kind of bank, so we get different kind of crowd. But just to understand, if HDFC deserves this kind of value, how CUB has done with respect to HDFC. And this is like 13-year, 9-year, 4-year CAGR history. And keeping public sector banks aside, this is how the private sector bank has done. And if we look at CUB history on a 9-year basis, they're as good as all the private sector banks. But on a 4-year history, it has performed little bad compared to the bank. So key numbers in a nutshell. So CUB is a mid-sized bank with almost 47K deposit, 38K loans. That 13-year CAGR for the CASA growth has been around 20%. With a 30% CASA right now, which is not great, but it is not bad, and it is improving from 25% CASA few years back. Now it is to 13%, 30%. The ROA right now post-COVID and all, still it is decent at 1.36%, and the ROE is around 12.5%. And ROA and ROE, they are very, very important numbers for banking. And the gold standard is your ROE should not go below, it should be above 12%, and ROS should be above 1%. And given, the banks have gone through COVID cycle NPAs, this is like the worst ROE number which we have, and still they have been able to maintain that 12% mark. Because if we look into history, these boxes, you will see this bank has a ROE history of 15% and above for 6 out of 7 years pre-COVID. If we look at the bank history in terms of NIM, the bank has always maintained a NIM of around 4%. If we look at again 7-year history pre-COVID, the bank has always maintained less than 3% GNPA and 2%, less than 2% NNPA, though the current number is much higher. Like against less than 3% right now, this number is 5.2%, and NNPA is 3.4%. And we'll look into it why and how. And also, if we look at the other history in terms of EPS growth, in terms of CAGR growth, advances, everything looks much better if we look at a 7-year history, though the current numbers may be very, very different. Now, as I said, CUB is a mid-sized bank, and it is predominantly into MSME lending, which is medium and small scale industries. So MSME and agriculture is like almost 50% plus, and then they have small allocation in other sectors. A little bit about MSME sector. So what is MSME sector? So basically, this is a sector where which promotes small and medium-sized enterprises. And if you look in terms of, it's micro, small, and medium. And if you look at what is micro, what is small, what is medium, for a manufacturing enterprise, for a service enterprise, it defines in terms of what is their capability to be called as MSME based on their revenue and all. So these are based on their capacity of investing in the plant and machinery and how much is there, they call it. And this is where CUB lends. So you can assume that they may not be lending to very big ticket size customers. Loan ticket size will be lower. But MSME sector is important for GDP growth rate. It has a good contribution in terms of total export growth rate. It employs more than 11 crore people. What is important is this sector is being funded only 22% by formal financial system. And one reason being this is a difficult sector to work. Because if you look at the segment-wise NPAs even before COVID, this is a sector which always has high NPAs. It's a risky sector because not every small company makes it big or grows. And that is why maintaining a good banking track record in this sector, that's a niche skill, and not all the financial institutes, they have been able to do well. And this is where CUB has tried to build a niche for itself. Also, if we look at the bank in terms of the loan, in terms of their income breakup, so bulk of their profit historically has come from interest and loans. This number right now will look very different because in COVID, they have not made much profit on the core interest income. And again, we will show you the P&L performance. But historically, this is how it has been. And the core income has been high and the other income has been low. Also, in terms of loans, a good amount of loan is more the working capital loan. 60% is working capital loan and 40% is term loan. And in terms of other income breakup, they get from treasuries, from CEB, and some from recoveries. And 95% of the loan is floating rate loan, and only 5% is fixed. Now, as I said, ROE and ROA, they are very, very important number for any bank. So how good or how bad is CUB Bank? Let's try to evaluate by comparing with other banks over a longer history. So what I have given you here is basically we have tried to compare CUB with some big size bank and medium size bank over a 7-year pre-COVID history, because COVID has given a lot of spikes and irregularities to the number. And if we see the 7-year mean ROE, CUB stands almost second after HDFC Bank. So CUB is almost the second best number, and this is all the year-over-year number. Same thing if you look at the return on asset, again CUB is almost at number 3 after Kotak and HDFC, which are the two best banks. So if we look historically, CUB looks like having the best ROE and ROA numbers after HDFC Bank and after Kotak Bank. The third important factor is leverage, because many times ROE and all can be generated through high leverage. So if we look how CUB is placed on the leverage, Kotak number will look very low, below 5, because Kotak, even though it's a bank, if you look at the Kotak numbers, it's different businesses, and there is a lot of non-banking business which still sits inside Kotak. So that could be one reason why it is very low. But then if you look at all the other banks, HDFC is the best place, like they generate the best of the numbers at at a very low leverage compared to other banks. And so CUB is again at the second position. So it's not like they're highly leveraged and all. Still, compared to other banks, they're a better place, though there could be a difference in the type, nature, and type of lending. But this also looks well placed. If we look at CUB performance of last 7-8 years, including COVID, like I have taken the December 21 number, which is the latest number. And if we look at metric related to business growth, whether it is on asset side or the liability side or the CASA. So if you look at deposit growth rate, they have been growing around 12, 13%, 17%. But last 2 years post-COVID, this has come down to 6 and 5%. Same if we look at the advances, they were growing at 12, 17, 13, 17%. And during COVID, post-COVID, this has again fallen to 5, 6%. CASA is something where they have done, most of the times they have done well. See, this number 9% is, I am trying to compare the last 1 year number with 9-month number. So when you will see all this with 12 months number, of course, these numbers will increase. It may go to 6, 7%. This may go to 12%. But it is lower, and we can see during COVID, all the numbers have gone down. But pre-COVID, the numbers look good. If we look at the P&L, so in banking, there is a core profit which comes from the core lending business, and then banks generate a lot of other income through fee-based or through the deposits, and through by putting some of the money in in different instruments. So there is a core income coming out of lending through interest, and then there is a non-core income. And many banks, I think apart from HDFC and Kotak, I'm not sure if many banks generate profit on core income. And what I want to highlight with this is, let me just go and show you. So this is what I mean by core income. If you see this financing profit in the screener, you can see every year CUB has generated profit except COVID when it went in negative, and again it is generating profit. And the other part is other income, which is this one. So if we see core income was decent, and even if you look in COVID, the CUB's number this year, of course, it went down, and then again it is up. But all this is coming through the other income. The core income has not contributed because of a lot of NPAs and provisioning. So just keep this factor in mind. So now if we look at the profit, the core income profit was growing almost for last 7 years. This has kept on growing. But in COVID, this is almost like down to nothing, like 0 and 60 crore. And still the overall profit, total profit number, it had taken a dip here in COVID. And again, this number has almost reached to previous high, which has happened because of the other income. So if core income growth comes back, I think there is good scope for growth, provided the other income still remains around the same level. But I just want to highlight this factor, and we'll analyze later. In terms of NPAs, if we see, so this is the NPA position. So every year this is the opening balance, and then some NPAs get added, and then the company does some recovery, so it gets reduced, something gets written off, and then we get a closing balance which is passed to next year. So what we can see in terms of gross NPA percentage and net NPA percentage and credit cost and all, if you will see, this number used to hover around less than 3% pre-COVID. Even if you go in previous years, this number was less than 3%, and your net NPA numbers were below 2%, which was decent, and the provisioning credit cost was somewhere around 0.8, 0.6%, that kind of number. After COVID, there has been a spike in NPAs. If you see, the company used to have, of course, with the increasing size of balance sheet, the NPA will also proportionally increase. But post COVID, this number has gone almost double and then further increased here, almost from 632 crore to almost 1100, 1200 crore. What is interesting is finally looks like this number is saturating and settling down. And if we look at the quarter by quarter result, we will see it peaked somewhere around 5.4%. And then in the Q3, this number has come down. Other interesting thing which has happened is, if you see, so far, the recoveries were only less than 200 crores. But in this financial year, in 3 quarters, they have done 300 crores of recovery. And last quarter, almost they have done 134 crore of recovery. So even if in Q4 they do 100 crore more, the recoveries will go to 400 crore. From 195 crore kind of recovery, it will go to 400 crore. So you can imagine when the better recovery is happening. And if you see also the additional NPAs which are coming, that also seems to be peaking out, because here you had FY21 1113 crore of NPA, and right now it is somewhere around 1054 crore. So this also looks like almost saturating, given they are still growing the balance sheet at 8-9%, and the same will get reflected here. So looks like we are peaking out, and the recoveries they are showing. One reason they highlight is because of COVID, there were a lot of restrictions in going and doing the collection. And as the economy is opening, the recovery is improving. So this gives a hint of maybe we are somewhere closer to bottoming out of NPA cycle. The same if we look in terms of the restructured borrowing, the restructured assets. Again, if we see the numbers, whether we look at the number in terms of number of borrowers or if we look in terms of amount, we see like in September, the borrower count has also peaked out, and the restructured amount has also peaked out. So if we combine all these numbers, we get a sense that maybe we are closer to bottoming out in terms of NPA cycle. And when the NPA cycle is at peak and showing the first sign of bottom, where are we in terms of valuation? So if we look at the valuation of City Union Bank and compared to all other banks versus its own history, the best of the banks like HDFC, Kotak, they trade the mean P price to book value has been around 3.5 to 4, whereas City has traded at a mean price to book value of somewhere around 2.1, just little below Axis and still little above ICICI. And if we look at the peak and the bottom, at best of its time, City Union Bank used to trade at a 3.1 book value. And currently, 2 days back, when I was preparing this, the stock was trading at 113 rupees, which was 1.3 book value, which is almost the lowest book value in last 8 or 9 years of history of Citibank. Of course, if we go 20 years back, it was trading lower. But last 7-8 years, when the bank has been recognized, based on performance and all regularly, continuously, this is the kind of lowest P. So given we are at the lowest valuation cycle right now, I mean, it can go to 1 book value also, but given we are getting signs of the NPA cycle to peak out, things to improve, and at its lowest price to book value, which is almost a 40% discount to historical mean, this tells something about the valuation may not be so overvalued, or maybe I don't know if we are at the bottom of the valuation and we are trying to pick at the right time. Let us try to understand the same thing from charts, because fundamental wise valuation does tell that looks like there is some value to be emerging if it has peaked out in terms of its NPS cycle, and if it has bottomed out along with the industry in terms of growth cycle, because you saw the company has grown at 6-7% deposit and the lending rate, and the banking credit cycle also you saw that it's somewhere around 8 to 9%. If we look at the charts during COVID time, the stock got a support somewhere around 108, 110 rupee. And why I got interested at 113, because the stock was exactly at the same level. And if you see exactly same level, a big tail, you can see the dozy, is a bullish dozy, which tells, all of a sudden here, your buyers or the bulls overpowered the bears. So maybe the stock is getting support here in terms of, RSI. It just the weekly RSI hit the 30 mark. And historically, if you see, whenever stock goes to this kind of RSI, you see the bottom getting created. This was 2016, 2018 also, when we went here, bottom got created. Let's see if we are third time lucky and this is the bottom. But this is what the chart says. There is no momentum at all. It is more about, are we at the bottom of the price downtrend or not? Will it get support here? And other thing which you see, there is a huge volume support here, and this huge volume support goes off here, which means if by chance this breaks this level, then the next set of big support might come somewhere in this range, which is like around 88 rupees, because not much is here between 88 rupee to 107 rupees. And why this fall has happened, if you see, the price has actually fallen from 240 rupee to 110 rupee, which is pre-COVID almost a 60% plus price fall. And the reason being MSME sector, one, the banking sector has been hit, the banking sector credit growth has been hit, and MSME has been one of the worst performing sector where CUB operates. So the impact on CUB has been relatively much more higher. What is exciting? So, okay, we saw there from valuation perspective, it is almost at a lifetime low valuation. From a chart perspective, still it is in downtrend. We don't know if it will fall further or the same 111, the price will get support. But for the price to move in uptrend, something good should happen. So are there any triggers? So one thing which excites, see, whenever it comes to banking is one sector where, more than anything else in banking, I respect the past a lot, because banking is a business where all the good news is front loaded and all the bad news is, it will come later on. So we should be very sure of the history of company performing in bad cycle. And a company with a 50-60 year history always give confidence, because every company is touted as the next STFC, but many times it results into the worst performing bank. Whether, it's not about fraud, no fraud and all, but we know the history of, Yes Bank, RBL Bank, there have been so banking casualties. And the banks which try to grow most aggressively, many times those are the banks which backfire when actually NPAs happen and all. So in bank, I am still okay compromising on growth, but I don't want to compromise on the quality of the bank, the philosophy of the management. And that is why understanding the past history is very, very important. And when it comes to this bank, the past history gives good amount of confidence. And why? Because one, this company has almost 115 years of history and a very good track record of profitability and dividend payout. So this means this bank has seen multiple cycles and they have been successful in across cycles. Of course, performance fluctuates, but still they have been profitable, dividend giving. And this bank has seen only 7 or 8 CEOs. So you can assume, in 100 years, 7 CEOs, and they have managed this company well. It tells a lot about the culture of the bank. We already saw the ROE and ROA number for last 7 years pre-COVID, which gives a lot of confidence. Also, banking is all about granularity, and the 7 sins of banking. I have spoken about this when I presented the other bank, Karur Vyas Bank, few days back. And if you have not seen that video, again, the link is there. You can see this video and you can try to understand the 7 sins of bank. But granularity is something which helps, because if the bank is making concentrated bets and bets go wrong, then it can backfire, whether it is asset or liability. And if you look at the top 20 largest borrowers, hardly 5%, and top 20 largest depositors, hardly 9%, which speaks about granularity. Then 99% of the lending is secured lending by collateral with a decent amount of collateral. So even if the NPAs are coming, there is chance of recovering through the collateral and all. They are a very focused bank. They try to focus on a small industry, SME, MSME, and they've tried to build their expertise there. And most of the clients, they try to maintain a single banking relationship with minimal exposure to consortium and multiple banking arrangements, because this is where many times issues happen. And the bank has done all the required additional provisioning for COVID. And if you look at the con calls, the kind of guidance they have given, how they will emerge, they have done a little better than the guidance given, whether they have targets around ROA, they have targets around slippages. They have done almost well. And growth wise, they may not be the best, but as I said, in banking, I don't want the highest growing bank. I want something which has been more consistent. And the bank has matched the history of how the banking industry has performed. Of course, last few years they have been little lower, but still, it is decent. So the past is good, but future is important, because if there is no growth, if there are no good news, then the price still remains upside and maybe the chart is highlighting. So what all could change in the future? So the first itself is, can the bank grow? And if we look at the potential of MSME, as I said in one of the slides, it is still under penetrated in terms of the organized lending. And if you look at the addressable credit gap, still, there is a huge amount to be fulfilled. And they're present primarily in southern India, which is a big market from MSME perspective. So it looks like there is a growth opportunity available. And we discussed about this chart. So looks like the whole banking sector peaked out in 2019-20, and the sector has not done well from last 2-3 years, which is again reflected in the credit cycle. So if the GDP has to grow, this credit cycle cannot be like this. It has to revive. And retail lending has done good, and it has not been super aggressive, a 15% CAGR, and the same thing is expected to grow. And the private capex cycle or the rural cycle is expected to revive a little bit, which can bring more growth. So this should help once this credit cycle revive. The overall banking growth rate, which has gone down to 8%, that might revive. So we might be at the bottom of the cycle. Nobody knows, but history says so. This is how cycles bottom. And whenever opportunity will come, there is a huge growth opportunity, and that kind of growth has come in MSME in past. And if the banking cycle changes, if the credit cycle changes, that kind of growth opportunity can again come. And we can see that if the NPAs are getting peaking out, if the recoveries are increasing, slowly we'll see the NPAs decreasing, the provisioning cost decreasing, credit cost decreasing. So with more recoveries, the profit chances of improving profit is higher. If we look at the management con calls, they're telling that they might take some hit on the other income, which actually supported in the COVID times. But what will happen is this first, that it needs to go back to the regular level of pre-COVID financing profit. And if the growth comes back, this should get further boost. And with better recoveries and NPA management now, given we are peaking out, it should get further boost. And this should go little down, but still overall level, maybe this could bring again the double-digit kind of growth which the company used to have earlier, when the mean PE book value was more than 2. Also, we already spoke about the NPA, how we feel like NPA is peaking out and all. And in a nutshell, if we look at, so recovery performance has been better than expected, and it is increasing. And with economy opening, the chances are, the recoveries will be more than double of previous year. It's at lifetime high. The NPA addition is normalizing. If you see this particular interview on CNBC, which was post Q3, they are giving indications that it looks like the time for growth. So they have kept pedal on the growth because of consciousness of COVID. So even if the NPAs were increasing little bit, they could have hidden it. The NPA was not so high at 3%. They could have hidden that with some credit growth, but on one side they were not growing. That is also a reason why some of the NPAs look little hyped up. But they're telling that at the right time, when they feel the market is right, they will grow. And looks like they're giving indications that it's coming back. They expect ROA to reach at 1.5% in the second half of FY23. But looks like now itself in this quarter they have hit the 1.3% mark. So maybe in Q1 or Q2 itself they might reach this level. So again, the performance has been better than whatever they've been. This is where some slowness is expected. So overall, your NPA and core growth should help in the profit growth. So why the story can fail is multiple reasons. First, you saw MSME is a very, very tough sector to operate. And in COVID, it has gone through one of the worst pain. So if MSME sector doesn't revive, then it would be difficult, but the management is giving signs that things are coming back to normal. It is predominantly a South Indian bank with almost a 50% concentration in Tamil Nadu and 70% concentration in South India. So there is a geographical concentration. If something bad happens in southern part of India, the bank will get impacted. The CASA and fee income, it's good. It's improving. Like CASA is improved from 25% to 30%. But if you look at the best of the banks, around 45% kind of CASA, the company still has a lot of ground to cover. And there are other banks who have done better than this bank in terms of CASA. And also the fee income on other income products. Now slowly, they're trying to get into insurance selling and all. But this is something again which they have not tried to tap. Also, if you see last 3-4 years, COVID and pre-COVID, there is little bit of tapering of growth. So the question is the company giving up to the next gen kind of banking? It's very interesting because you will see in last con call, they focused a lot on digital and they told that we never spoke about it because we felt we are doing what every bank should do. But given it looks like people are getting a feel that we are the one who are left behind, let me highlight what we have done on the digital side. It's a very interesting read up. So the growth tapering might be a track to it's a old bank which is losing on digital, but I think that commentary gives some level of confidence. COVID, of course, has led to a deterioration in asset quality, and in last 10 years, it has happened for the first time with this kind of NPS above 3%. But we hope that with again economy coming back to normal, this will be taken care. There are some security risks in the past, and those kind of risks may occur again. And some of the sectors which bank used to lend, like that went through more higher pain because the MSME industry itself gone through pain. But like if these sectors open up, like hotel and all, I hope again those pain will be relieved. And last is the promoter doesn't hold a big significant stake, which is usually important. So that is a drawback. But the biggest risk which I see right now is, off late in last 1 month, everybody has spoken about FII selling heavily in banks because FII is selling in India. And see, all that value investing principle, everything is fine. But you have more sellers and less buyers, you can't help it. So that is why I say I rely a lot on chart, because having value in a stock doesn't mean the price cannot go down. So that is something which we need to be cautious. And when it comes to this bank, actually the FII selling phenomenon is not a last 3 month phenomenon. But if you look at the FII stake from March 19, the stake has come down from 24% to almost 16%. And you can see this, this FII stake which has come down. Now the question is, if FII and what is more interesting is, so this is the FII stake, which has come from 24% to somewhere around 16%. But one more interesting thing is in FIA, these are the FIA institutions. But the other thing which has come down in this stake is the retail stake. If we see, the retail stake has also come down from 14% to 9%. So both FII institutions and retail are selling. Then the question is who is buying? And it is interesting who is buying, because when we see it is the domestic institutions which are buying. So the FIIs are selling, the retail investors are selling, but the mutual funds are buying. And the mutual fund stake from 2017, from a 12% stake, this has gone up to 33%. And the insurance companies are buying because their stake has gone from nowhere to almost 7%. So foreign institutes and retail is selling, and DIAs and institutes, and this slide is wrong. It's more mutual funds and insurance. These companies are buying. But if FIIs can keep selling and no mutual fund buys, again the price pressure can happen. So what I am doing right now, I am avoiding this stock in my momentum portfolio for simple reason. There is no momentum. Certain specific criteria for my momentum, and I will discuss in some of my video how I play the momentum portfolio. And there are times when I again take stake both in the funda portfolio as well as momentum portfolio. There are times when I don't take stake in funda, only in momentum, and there are times when I take only in funda. So right now it's a position where I feel there is a value emerging, and I don't know if prices will go down. So what I've done is, At 114, that 111 support level, I have allocated 30% of my desired allocations. So if I can allocate 100 rupee in my funda portfolio, so first at portfolio level, I will have certain allocation for my momentum portfolio, certain for funda. Right now, this is very, very less because the market I am not finding conducive to trade. So this portfolio is very less. So this is the portfolio. In that portfolio, like if I can buy for 100 rupee this stock, I have just given almost 1/3, because what if it can fall down to 86 rupee? But the idea is, I'm very convinced by history, this company is not going to go bankrupt. In fact, this company is one of the most quality companies. They have been conservative. I can see the green shoots coming. That doesn't mean the price cannot fall. If 5 years are selling, prices can fall. But if it comes to 86 rupee, maybe I will deploy my 7th tranche. I will again see the next support level. It comes there, I'll deploy my third tranche. So the idea is, even if come down, I would like to buy at a certain level where my book value itself becomes almost, close to, 1.1, which I feel it can further go down. Nobody can control prices, but the idea is not to look at a stop loss and exit, because I have all that trust. And the idea is to buy value and then let the cycle change, whether it will change after 6 months or 1 year, and how does it happen, time will say. But I don't see any momentum in the stock immediately, which means there are no immediate expectations until as that 111 stop, that support works for. It's all about CUB Bank. This is all about banking. I will try to talk more about banking because it's at an interesting juncture in terms of cycle. Recently, I saw 2 interviews of guys whom I respect. One is from Mr. S. Narain. He was interviewed by Multiply. The Multiply video link is there, and there are questions around banking. So do check his views on banking as a sector. And second, there was a Twitter Spaces session organized where Mr. Manish Shokhani was there, and he also looked optimistic on banking and this whole credit cycle logic which was there. So I also believe in that, and I will try to put my views. But those are some of the interviews. In case you find in public domain, you can try to see. The other thing is, I used one report by Kotak in this analysis, which I found really good in terms of 25-year banking cycle. So try to find some of those reports, read about the banking cycle, and I'll see you in the next video sometime. Thank you.